Hi. All right, I'm excited to get into episode 322, Guaranteed Income with a SPIA. And the question is, does it make sense to purchase a single premium immediate annuity at retirement to increase your guaranteed income? And using the word annuity can be a little bit confusing because there are so many different types of annuities out there. Today we're going to be talking only about the SPIA. Single Premium Immediate Annuity is what it stands for. Some of the other annuities that exist, and I think this is one of the reasons this topic around annuities can be confusing, is because there's a lot of different types of annuities out there, and sometimes people will use the term annuity and they just kind of lump everything into one category. But some of the other types of annuities are DIAs, which stands for Deferred Income Annuity, MIGAs, which stands for Multi-Year Guarantee Annuity, fixed deferred annuities, fixed indexed annuities, and variable annuities. But again, today I'm not going to do an entire episode on all of the different types of annuities. I just want to explore this single premium immediate annuity, the type of annuity that many people in the academic community point to as a tool for providing guaranteed cash flow. But I want to look at it today in the context of this environment that we live in now, this current interest rate environment, and look at it from a couple of different angles. So a few things that you are going to want to consider as you're making the decision about whether or not you should purchase guaranteed income is, number one, you need to understand how much other guaranteed income sources you're going to have. So add up everything like your Social Security and your pension income. That's what we consider guaranteed income, not your withdrawals from 401ks or IRAs, but just the guaranteed income. And then the second thing that you're really going to want to understand as you try to explore whether or not you should be purchasing additional guaranteed income through something like a SPIA, a single premium immediate annuity, is you really want to understand your essential expenses. I don't think it's necessary to try to guarantee all of the income that you're going to need in retirement. But if we can guarantee 80% of your essential expenses, if 80% of your essential expenses are covered by guaranteed income, it's going to take away a lot of sleepless nights when things get a little wobbly in the economy. And let me just say, I do think we are in for more of a roller coaster ride as we look out into the next 6 to 12 months for sure. In many instances, Social Security creates enough of a floor to satisfy the 80% of guaranteed income relative to essential expenses. So that's one of the reasons we put so much emphasis on Social Security as an asset class, because it really can provide that floor that many people need from a income standpoint, especially in the context of thinking of this in terms of your essential expenses. Not all of your expenses, so not including travel and spoiling the grandkids and Christmas and some of these extra things, but just the essential expenses. If we can cover 80% of the essential expenses with guaranteed income, then again, that just creates a lot of certainty for people, which is really what we want. We want to try to keep your stress levels down as you're making this transition into and through retirement so you can enjoy life. So you're not spending your time worried about the economy or your investments or the future. Now, I want to emphasize in today's show, this is not a recommendation to buy an annuity, nor is it a recommendation to avoid annuities. Rather, the purpose is to examine the pros and the cons of guaranteed income when compared to other strategies, especially in the reality of today's economic environment. Because what made sense in the past may not be the best strategy given the economic reality that we're all living in right now. This crazy environment where interest rates are on Treasury inflation protected securities are negative. 10-year Treasury bonds are 60 basis points, less than 1% per year. So we've got to be thinking not just in terms of how things worked in the past, but we also have to be thinking about how things are working now and going forward. In order to make this podcast relevant, I needed to create a scenario, and I'm going to explain to you the scenario here in just a minute. But I want to look at 3 different options for this scenario. Option number 1 would be buying a single premium immediate annuity for guaranteed income. Option number 2 would say, instead of putting that money instead of purchasing the annuity, what if we just put it into a savings account and we started taking withdrawals from that savings account? And then option number 3 is, if we use those funds, instead of purchasing an annuity or just putting the money into a savings account, what if we did something like we put the money into a 50-50 stock bond portfolio and then we assume the 4% withdrawal rule? So I want to compare the difference between using the guaranteed annuity versus some of these other withdrawal strategies. So as we start to talk about annuities, let's first just define what a SPIA is. What is a single premium immediate annuity? The first thing you need to understand is that all annuities are issued, they're contracts with an insurance company. So all annuities are contracts with an insurance company. This specific type of an annuity is one that guarantees to pay income for either a set period of time or a lifetime. So an easy way to think of a SPIA, a single premium immediate annuity, is to think of it in terms of a pension. It's just guaranteed income that's going to last either for a set period of time or for the rest of your life. In today's exercise, we're going to look just at an annuity that would be guaranteed for lifetime. In fact, we're going to do it on joint lifetime. An annuity contract, a single premium immediate annuity, is the only financial vehicle where you can use the word guarantee when it comes to future cash flows. You can't guarantee rents from real estate. You can't guarantee withdrawals from a 4% withdrawal strategy. You can't guarantee interest from and dividends from stocks and bonds. So a single premium immediate annuity is the only tool that we can talk about the word guarantee. And of course, remember, guarantees are based on the financial strength of the insurance company that you're working with. So an important thing to consider if you're going to be buying an annuity is to understand the financial strength of the company that you're working with. Let me just say, sometimes annuities can be rather complex depending on the type that you're looking at. Remember, today we're just looking at this one type of annuity. But single premium immediate annuities, SPIAs, are usually considered very simple and easy to understand. They're not complex, and they tend to have very low fees. You also benefit from something called mortality credits. And the idea with mortality credits is we're pooling life expectancy. The reason that payout rates sometimes can look more attractive from an annuity versus other sources is because the insurance companies can pool life expectancy. If you think about it, what we're doing is we're diversifying life expectancy risk by having a lot of people participating in it. It was once said that the only free lunch in investing is diversification. Well, the only free lunch in cash flow from a guaranteed standpoint is, again, diversification. It's just saying some people are going to live a long time and some people are going to die relatively soon. And because we don't really know when people are going to die, we can pool life expectancy risk. And that's what we mean when we talk about mortality credits. The reason that this is important is because, remember, two of the biggest risks that we face in retirement is the uncertainty of time, how long does the money have to last, and volatility. And so one of the reasons the academic community has been a fan of something like an annuity is because it takes away both of those risks. It eliminates the time risk because we can guarantee the income for the rest of your life. And it eliminates the volatility and the stock market risk because this money's not in the stock market. We're exchanging dollars for a guarantee from an insurance company to pay money for a set period of time or for life expectancy. These annuity contracts can be kind of hard to wrap your mind around because most people that are getting ready to retire, we've all been in accumulation mode all of our lives. And so now we're transitioning into cash flow mode, and people still think about their money in terms of rate of return, but that's the wrong way to think about something like a single premium immediate annuity. In fact, I would say most people don't talk about these types of contracts in terms of rate of return because it's an unknown. It depends on how long you live. If you live long enough, there can be an internal rate of return. If you die at life expectancy, maybe there's not. And if you die before life expectancy, then essentially what happens is you could have paid more money into this thing than you're going to get back out of it, and the people that live longer benefit from those mortality credits. Now, one of the things that has detracted a lot of people, discouraged a lot of people from purchasing something like a single premium immediate annuity, is this idea of buying a contract and then 2 weeks later you die and there's nothing left to be paid to your heirs. Now,